Hello and welcome to Bold Radio. I'm your host, John McLeese. Sometimes in life you just need some good advice, and we have lots of good advice here. No one is an expert at everything, and that's why we're proud to present the Bold Radio Expert Series, where we welcome a qualified and experienced individual to offer sound advice on an aspect of running a business. Our guest today is the highly qualified financial expert. We are pleased to be joined by Leanne LaRiviere, Manager of Consumer Lending at the Steinbach Credit Union. Leanne will bring her expertise today on the subject of refinancing your mortgage. When running a business, one option of accessing additional funds just may be through the equity in your home. Refinancing your mortgage can be a low-cost way to borrow money than taking out a traditional loan. Leanne, welcome to the program.
Thank you, John.
It's great to have you here. What is mortgage refinancing for the novices out there?
So, John, a mortgage refinance allows property owners to access equity out of their residence, a rental property, or a vacation property that they have. Now, the amount of equity available to them is really based on a few things. It's based on their current property value. We also take into account what is their current outstanding mortgage balance and what is the maximum advance ratio that we can lend to. So one thing that we would definitely recommend is you're going to want to talk to your financial institution that you're working with on what does that maximum lent out ratio look like, because it's going to vary based on the property. So whether it be the property I'm living in, perhaps I have a rental property or a vacation property, that amount that the credit union or the bank is going to be able to borrow you is going to vary. So that's really an important factor.
So would you loan me this money to finance a business venture, as well as certainly improving my, building a pool or doing some landscaping? Like, is there restrictions on how I can refinance a mortgage?
John, there's many, many ways that you can use that equity. And what we have found is that it really depends on that specific property owner, what they'd like to use that money for. You can use your equity to consolidate debt. You can use it to pay out maybe some credit cards or some loans that you have. We have had property owners want to take that dream vacation, maybe use it to help out their kids for education expenses.
But I could also use it to finance a business venture.
Absolutely. Yeah, you can use the equity, whatever you'd like to do.
So how would I determine then my property value if that has a lot to do with how much I'm able to borrow?
Yeah, so there's a few ways that you can determine your property value. So let's say, for example, I'm living here in the city of Winnipeg and I want to find out what's my property worth in Winnipeg. So the easiest way to do that is I can take a look at the assessment that the city sent me in the mail, and every year they update us with that information. Now, that's okay if you lost that assessment and you can't find it. You can easily go on the city of Winnipeg's website and take a look to find out what is the current value of your property. Now, there is another way to do it as well. You can actually get an appraisal done on your property. So now what this involves is a professional appraisal company will actually come right to your property and do a full assessment and provide a report to your financial institution on what is the value of that property. And so your financial institution that you're working with, they'll guide you through this process and they'll help you order this. So this isn't something that you have to go and obtain on your own.
Okay, so now I've decided that I want to get a loan or refinance my mortgage, and I have an idea of the value of my property. How much can I afford to borrow? What are the what are the costs I have to consider in the amount that I'm going to be borrowing?
So that's a great question, John. So this is going to vary depending on the property owner, and at the financial institution that you're working with, there's something we use called an affordability rule. So what that references is it takes into account how much that property owner can afford based on their current monthly income and the financial obligations that they already have. So we have two magic numbers that we're working with here. There's something called a GDSR and a TDSR. So the GDSR, we don't want to exceed 32%. And what that is we take your monthly income and we divide it by your mortgage payments, your utilities, and your property taxes, and we don't want that to be more than 32%. Okay. Now there's something called a total debt service ratio, or a TDSR. Now what that is that's 40%. We don't want that to exceed 40% of your monthly income. So we take that mortgage payment, those utilities, and those more property taxes, as well as any credit card payments you might have, loans, lines of credits, and we want to make sure that we stay within that guideline. Anything more than that, it may be difficult to make that monthly payment.
So there's a way that you kind of determine that based on some of these other basic payments that I have.
Absolutely.
What makes sense for me. Now, let's just talk about how much equity do I have? Help me understand that. If I have a property, and give me an idea of how much equity I have.
Okay. So, John, let's say I took a look at the city of Winnipeg and I took a look at my property assessment and it's $350,000. So I'm living in the property. So I go to my financial institution. And remember, we talked about that maximum lent out ratio. So for my owner occupied residence, I can be lent up to 80% loan to value. So what that allows me to do is go up to 80% of $350,000. So that's $280,000 available to me to be lent out. Now, earlier we talked about we got to take into account how much do I already owe on my mortgage, though. So let's say I owe $200,000 on my mortgage. That gives me $80,000 of available equity that I can use for this mortgage refinance.
It's very simplistic the way you were describing it. So how could I access that $80,000 if that was the determining factor?
Yeah, so there's actually a couple different ways that you could option it. Again, depending on what's going to suit you and your family best. By taking that $80,000 into your current mortgage, property owners can have one payment. So what that allows them to do is take whatever equity they're using. Let's say, for example, they want to use that $80,000 to pay off some credit cards and some loans. So let's say I had a car loan for $40,000 and some credit cards for $40,000 as well. So I'm making my payments on my credit cards. I'm making my payments on my car loan. By refinancing my mortgage, I've now amalgamated everything into one payment. What I'm doing there is I'm reducing my monthly payments and I'm saving on interest costs because let's say, for example, I was paying 6% on my car loan. I'm paying 19% on my credit cards. Our 5-year mortgage rate right now is 2.65%. So you can immediately see those savings.
Consolidation, refinancing of your mortgage for a business loan or to enhance your lifestyle in other areas, best to talk to an expert like we have today. Leanne LaRiviere, Manager of Consumer Lending at SCU, Steinbach Credit Union. Leanne, thanks very much for joining us.
Thanks so much for having me.